Okay. Hello and welcome to this EU Tax Observatory event. Today we have the pleasure to present to you the evidence and conclusions of a novel study that we have released a few days ago, which is on the state of intra-European tax competition, both in personal and in corporate taxation. The observatory is an independent research center tasked with conducting innovative studies on taxation issues, especially on tax evasion and tax avoidance. We aim to promote democratic, inclusive, and pluralistic debate on taxation matters by fostering dialogue between the scientific community, civil society, and policymakers around the world, and especially in the European Union. We are an EU-funded project. However, our work is independent and it reflects the opinions of our researchers and not necessarily the views of the European Commission, the European Parliament, and other European institutions. So the usual disclaimers apply to what you will see today as well. The study that will be presented today is the first to gather all available evidence on harmful tax regimes that currently exist in European countries. And I think it is the first also to document patterns of how these schemes have increased in recent times in the European Union. We try as well to provide an estimate, the back of the envelope calculation of the taxpayers' loss that results from these policies. We have the pleasure to be joined today by two distinguished members of the European Parliament in the discussion that will follow the presentation, Mr. Markus Ferber and Mr. Paul Tang. It is an absolute pleasure to welcome both MEPs to this event, as well the participants in the presentations and the discussion. I would also like to welcome all of you who have tuned in and who I extend an invitation to join the discussion with your questions at the very end. The report will be presented by two of the authors and colleagues of mine, Sarah Godar and Eloi Flamant. So without further ado, let me pass the floor to Sarah and Eloi for presenting the report, and I wish everyone a fruitful discussion. Thank you very much. And Eloi, the floor is yours.
Thanks a lot, Panos. Thank everyone for being here, even though it's lunchtime. So we're going to try to make this presentation as tasty as possible. So we are really happy to present you a few key points of our report on tax competition in the European Union. So I'm going to give some introduction elements and cover the personal income tax competition part. And then I'll hand over to Sarah, who is going to talk about corporate income tax competition and give some policy recommendations as a conclusion. So first of all, a few reminders. A lot of you are already aware of all of that. So what is tax competition? So tax competition is the non-cooperative tax setting by independent governments when they are accounting for two things. So first of all, the fact that there is some mobile elements in the tax base that could move. And the second thing is the fact that there are other independent governments that are setting also non-cooperative tax settings. And so in economic terms, you have some governments that have to move from a first best tax system to a second best tax system because they are accounting for decisions made by other countries. So of course, this international tax competition has been increasing through recent years because of two main factors. So the first one is the fact that thanks to globalization, there is an increasing mobility of economic agents, both individuals and firms. And the second factor I find it important is the fact that you have also an increasing gain in law and accounting competencies of some economic agents, especially firms, that are more able to use various tax systems and to benefit from deduction and exemptions. So in theory, you could have some potential theoretical gains of tax competition, especially in the political economy framework related to a better efficiency of administration or reduced incentive for governments to overtax taxpayers. But it's difficult in the current context of a huge race to the bottom of tax rates, of preferential tax schemes that are specifically targeting new tax residents with the aim of cherry picking foreign taxpayers. It's difficult to defend the fact that there are beneficial effects of tax competition. If it's so, the downsides of tax competition are currently largely offsetting any hypothetical benefit of tax competition. So of course, because of this context of international tax competition, you have an EU action, and this EU action is relying on two main principles. So the first one is the fact that EU committed to tackle harmful corporate tax competition, for instance, thanks to the creation of the Code of Conduct for Business Taxation, but not at all of personal income tax competition, given that personal income tax is a prerogative of member states. And the second principle is that EU always made a difference between what they call harmful tax competition and non-harmful tax competition. And this dividing line can be difficult to grasp, especially if you consider that tax competition is harmful per se. And so this kind of dividing line between harmful and non-harmful tax competition could be difficult to understand. Why do we think that tax competition is currently harmful for EU and for member states? So basically, you could have first economic effects. So economic effects is the fact that when a member state is forced to lower its tax rates, to shift from a first best tax system to a second best tax system, that can jeopardize the resources of member states when they're forced to tax below their needs. Secondly, you have social effects because tax competition is unequal. Tax competition is targeting the richest taxpayers and the richest firms. Why? Because this type of economic agents are more mobile, are more likely to move. And so there is first an inequality, and also there is kind of an indirect effect, which is an incentive for member states to shift a part of a tax burden to the least mobile and least elastic categories of the tax base, because states need some resources, and so there is an incentive to tax more through indirect taxation or through tax on consumption, the least mobile. And finally, there is, of course, political effects. When you are in the context of an European Union, it's not the best way to cooperate than to try to cherry pick foreign taxpayers. So all of this apply to personal tax competition? So I would like to start with a simple graph that I find quite interesting, because basically you can see in that graph that you have two periods regarding personal income tax rates in the European Union. So first of all, between the middle of the 90s and the financial crisis, you can see this race to the bottom of the top marginal personal income tax rate that is going down. And after the financial crisis, what we see is that this decreasing comes to an end, because of course it's a crisis and it's difficult to go below some level of tax rates. And many people were saying at that time that personal income tax competition has come to an end because of this end of decreasing of top marginal tax rate. And in fact, it's not really the case. What we saw is that you have a shift from tax competition over the tax rates, so of a decreasing of personal income tax rate, to a tax competition over the tax base. And tax competition over the tax base in personal income tax happen through these preferential tax regimes that are granted with the common condition, that is that these regimes are granted only to new tax residents. So the consequence is that member states are keeping their actual tax base. So if you are in the country already, you can't benefit from the regime. So the resources of the regime on that population is going to be the same, but you continue attracting a new taxpayers through this type of regime. And you can see that in 1994, there were only 5 regimes of that type, and today there are 28 preferential regimes granted to new residents in the European Union. So what we try to do is to kind of give a typology of all these regimes, these different regimes. And for that, we chose 4 criteria to assess for the harmfulness of these regimes. So the first one is, of course, the regime duration. So the longer you can benefit from the regime, the more harmful the regime is. Secondly, you have the remuneration conditions. So this was to measure how much these regimes are unequal, because for a lot of regimes, you have to earn more than a certain threshold to benefit from the regime. So this can be explicit. For instance, I ask you to earn more than a certain amount of income to benefit from the regime. But it can also be implicit, meaning that if you want to benefit from the exemption, you have to earn more than a certain threshold. For instance, with the Italian high net worth individual regime, where you have to pay only a flat amount of tax that is equal to 100,000 euros. Of course, if you earn less than the amount where you would end up to pay less than 100,000 euros in tax normally, it's not beneficial for you. So it's only beneficial if normally you pay more than 100,000 taxes. So if you belong to the top income earners. You have also the professional activity requirement, because you have some regimes that are not requiring any participation in real economic activity, including jobs, and so that are only there to attract tax revenues. And so we wanted to account for that. And finally, you have, of course, the magnitude of tax benefits. It's the extent of the exemption that is calculated by doing the ratio between what a taxpayer that is not benefiting from the regime is paying compared to the amount of tax paid by one that is benefiting from it for the same amount of income. So for a new tax resident compared to a former tax resident. And when we did that, we found that table that is a bit cut off, but you can see that the more harmful tax regimes are the Greek and Italian high net worth individual regimes. And you can find also at the top some pensions regimes, especially because there is no real economic activity requirements, and the magnitude of tax benefit is quite high. Finally, I would like to present some key figures at an aggregate level. So we find that all these preferential tax regimes benefit to more than 200,000 individuals. And we have a lower bound estimation of 4.5 billion of what we call tax losses. So what is tax losses? Is that if tomorrow the EU decide to put an end to all regimes, the gain in taxes should be at least of 4.5 billion, which is equivalent to the annual Erasmus budget. I would like to point out that some people told us that if you have non-European beneficiaries, this is a net gain. And so it can change the number. In fact, we don't have the figures to account for every regime for the share of European and non-European beneficiaries. But what we know for the regime where we have this information is the fact that it's EU beneficiaries are between 70 and 80%. So it's not the minority, it's the majority of beneficiaries. And finally, what I would like to keep in mind is the fact that more than these figures that are important, you have an increasing dynamic. When you have more and more taxpayers that are benefiting from the actual preferential regimes, and you have more and more regimes that are created over the years. And so these two figures, beneficiaries and tax losses, are likely to really go up in the future. So this was for the personal income tax competition. And now we could see like how the new forms of tax competition occur in the corporate income tax world, and the mic to Sarah.
We can't hear you, Sarah.
Sorry, mic was off. Okay, I will start again. So I will highlight some of our findings on corporate tax competition. And yes, I think in the field of corporate tax, the effects of tax competition are much more visible in the European Union and have already been debated quite widely. So I guess most of us have seen this figure several times already, with the average statutory corporate tax rates declining from levels close to 50% in 1981 to close to 20% in 2021. And we also see a slowdown of this decline since the financial crisis in 2008, but the rate is still on a slight downward trend. And even in the last 5 years, about 9 member states have further decreased their tax rates. And in addition, countries have adopted many tax-based narrowing measures, which contribute to decreasing the corporate tax burden further. When we look at tax payments of multinational enterprises, recent research has shown that in relation to their profits, or if we set the tax payments in relation to profits, which we call backward-looking effective tax rates, the tax payment, or effective tax rates paid by multinational enterprises have declined by about 9 percentage points between 2005 and 2015, which can only partially be explained by declining statutory tax rate. So part of this decline is also driven by tax-based narrowing measures, and to a minor extent also by profit shifting. That's at least the result of this recent research. And here in this figure, we see the tax payments of the largest MNEs in relation to their profits. This is here represented by the blue bars. So this is backward-looking effective tax rates calculated based on country-by-country reports. And indeed, we see that multinational enterprises pay less taxes than what the statutory corporate tax rates would suggest. Yeah, we see here large discrepancies between the blue bars and the yellow and gray dots, which are the statutory tax rate. And this can have several reasons, and one of them is, of course, measurement error in the CBCR data. It can also be due to loss deduction from previous years, but part of this may also be due to generous tax provisions. And in our report, we analyzed some of those provisions that might contribute to this discrepancy between statutory tax rate and effective tax payments by multinationals. So just a few of them. So those might be investment incentives, which have become very popular, especially since in the last 5 years. Then research and development incentives, intellectual property regimes, allowance for corporate equity. And we also see a spread of unilateral tax rulings, which may or may not have a base narrowing effect. Yeah, we will see this in a minute. I will now pick out just 2 of those examples. So let's take a look at intellectual property regimes, which tax income from patents and software at lower rates or partially exempt those incomes from the corporate tax base. And this figure here shows the year of introduction at the x-axis, covering the last 20 years. And the preferential tax rate applied in those regimes here on the y-axis. And the bubble size should represent the relative generosity of the income definition. So this figure shows us that many countries have introduced intellectual property regimes over the last 2 decades, and that they tax this IP income at rates below 15%, or in many cases even below 10%. And yes, we argue that this might be a problematic development for the long-term sustainability of tax revenues, as the European economy is likely to grow more and more knowledge intensive, which is of course good. But this also means that a rising share of profits will be derived from IP income. So this kind of tax incentives is likely to get more and more costly in the future. And then we look at another trend in the European Union, that is unilateral advanced pricing agreements, which we see in this figure. Here we see the number of APAs in force in each year. And these are legal instruments that may be required by MNEs to clarify the application of transfer pricing rules. So these agreements do not automatically imply a low level of taxation in favor of MNEs, but the LuxLeaks scandal and also recent state aid investigations by the European Commission have shown that in several cases, tax administrations have used those sort of agreements to provide very generous interpretation of tax rules, and that decreases tax payments by multinational enterprises significantly. So as those agreements are getting more widespread in the EU, it might be desirable to get a bit more transparency about the content of those agreements and also the likely revenue effects of those agreements. So here's a last figure on corporate tax. Because sometimes it's the stable corporate income tax revenue as a share of GDP, which we see here in the blue line, is taken as an argument that after all the effects of corporate tax competition may not be so problematic. And indeed, the corporate tax revenues as percent of GDP have remained broadly stable or show only a very slight negative trend over the last 20 years. But I would say this is only part of the story, as at the same time, profits in percent of GDP, which we see here in the yellow line, have increased significantly over the same period. So as a result, we see here in the right figure that the ratio of tax revenues to profits exhibits a clear negative trend. So in a nutshell, I would say corporations receive an increasing share of EU GDP in the form of profits, but their tax payments have not increased accordingly. So then the question is, of course, if the corporations pay relatively less tax, who will pay more to compensate for this development? To summarize and conclude, we would say that the common market of the European Union potentially intensifies downward pressures on direct taxation, as firms and individuals can move more freely and are not, without necessarily giving up the benefits of public goods provided in high tax countries. And we find that tax competition has gained new momentum since the financial crisis, both in personal income tax and in corporate income tax. We see the rising importance of preferential regimes in personal income tax, and we also see many base narrowing measures in corporate income tax. Further, many of these tax incentives target the most mobile taxpayers, which are mostly high income earners and large corporations. So we argue that these developments bear the risk of undermining effective revenue collection and or weaken the horizontal and vertical equity of tax systems. So what can be done to encounter those trends? So in the report we suggest, just as I think the European Parliament has suggested as well, to extend the mandate of the Code of Conduct Group to also monitor tax competition in the field of personal income tax. And it might also reconsider the definition of harmful tax competition to also include, or to not only include preferential, but also non-preferential corporate tax regimes, which lead to generally low levels of taxation. Then, if it is not possible to include personal income tax in the work of the Code of Conduct group, or to tackle these new forms of personal income tax competition in a coordinated approach, we think or it's likely that member states will explore unilateral measures. For example, by taxing, they might continue taxing expatriates with high incomes for a couple of years after the departure, in order to reduce the attractiveness of preferential regimes in other member states. And with regard to corporate tax competition, we think that the global corporate minimum tax could effectively provide the floor to the race, to the EU race to the bottom corporate tax. But therefore, it's very crucial that the carve-outs need to be minimized, and that also only limited deductions from the profit subject to the global minimum are allowed. Otherwise, the EU minimum, the global minimum tax risks to become a very good anti-avoidance measure, but not a floor for the race to the bottom. Yes. Thank you for your attention. And now I would like to hand over to Jan Strupczewski, who is going to moderate the panel discussion and also potential questions by the audience.